Good morning and welcome to today's webcast, GASB Lease Accounting Changes for Governments. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from Moss Adams, Laurie Tish, Partner and National Practice Leader, and Ashley Osten, Senior Manager. Laurie, I'll turn it over to you to get us started.
Thank you, Emily. Today we're going to be talking about the new leasing standard put out by the GASB. You can see from the agenda that we'll be covering not only the background, scope, terms, and the overview, and the timing, but we'll go into some detail on accounting and disclosure requirements. We're also going to provide best practices and tips on preparing for the standard and implementation considerations. And we'll close with what to expect from your auditors. What will they be asking for when they come in to audit for the first year of implementation of this standard? Now, we do have a heavy attendance for this webcast, so I'm predicting that we may not be able to get to all the questions that are submitted. In that case, we will be doing follow-up with a document that does answer those questions. So please send them in. We're going to start off, before I get into any detail at all, with a polling question, Emily.
All right, our first polling question: how prepared do you feel to implement GASB 87? And your options are A, I'm considering early adoption; B, I've read the standard and feel prepared but don't plan to early adopt; C, I've started preparing but have a lot more to do; or D, this webinar is my first step towards preparing to implement GASB 87. And I'll give everyone a few moments to respond. To participate in the polls today, please click the button next to the answer you choose and hit Submit. And let's go ahead and take a look at the results. Laurie, back to you.
All right. So it looks like we have a number of people that have started preparing, a lot more to do. And the majority, this is their first step by listening to this webcast. So I am happy that we're able to give you a broad overview on getting ready for preparation. And no worries, you'll see from the timing that there is still plenty of time, although we need to start approaching it with a bit of a sense of urgency. All right, let's talk first about the background of this standard. The objective of GASB in publishing this standard was really to establish a single model for lease accounting. As you know, there have been a variety of ways that we have accounted for leases in the past. And I do just want to comment that we're seeing a trend by GASB for convergence. Convergence with not only FASB for the private sector, but also with international standards. So this is one in a long line of recent standards where we are seeing more of convergence and getting really all entities, no matter what their governance structure or the type of entity, to have similar accounting policies and standards. GASB has taken the view that a lease is a financing mechanism. In other words, they're looking at that at being the foundation for this standard. So the lessee is required to recognize a liability and that right to use lease asset, or essentially a capital asset. The lessor is required to recognize a lease receivable and a deferred inflow of resources. I'd like to provide some background on some of the key terms because this really drives much of the rest of our discussion. So we need to make sure we're all using the same language and understand the definitions as put forth by the GASB. I think we all understand that a lease is a contract that conveys the control of the right to use another entity's asset for the time specified in that contract. There is a series of definitions within the standard that defines short-term versus long-term, and that will become important later for the types of accounting that you will follow. And it is important to know that a short-term lease is a lease that at the time of commencement has a maximum possible term of 1 year or less, and that has to include any options to renew or extend. So they were very clear on this to avoid entities from being able to say, well, it's just a 1 year lease, but then we're going to add all these extensions onto it later. So they really do get to the heart of what that intent was at the time of commencement. Control of the right is another key term. Obviously, it's the right to obtain the service capacity of that asset that's in the contract, but it also has to include the right to be able to use it freely and determine the nature and how you're going to use that underlying asset. The lease term, that might seem like a simple definition, but this is where it can get complicated fast. The lease term is the period during which the lessee has a non-cancelable right to use that asset, plus any periods where either party has the sole option to extend or terminate. However, it's expected that it will go on. Now you can see this is where the judgment comes into play. This is where management will have to come up with a judgment call as to whether or not, even though there's an option to terminate or extend, you need to look to past history or what the intent is on the part of the parties for that term. The lease term actually would exclude periods, however, for when both lessee and the lessor have a sole option to terminate the lease. So if the control is completely out of your hands, out of one party's hands, that would exclude that period. Now, the GASB requires that the assessment for this term be made at the beginning of the lease term, and then you do not have to go back to update that or to analyze it unless there are unexpected options that were exercised or not exercised. So unless something unusual or unexpected occurs, you do not have to go back and revisit this every year. You make the assessment at the beginning of the term, and then unless something dramatic changes, you're probably good to go. Before we get into too much more detail on what the standard is, let's talk about what is scoped out. The statement does not apply to leases of intangible assets, things that are noted here on the slide, natural resources, licensing contracts for intangibles like patents and software. Now, when I look at the attendee list, I see that there are some utilities that have called in, and I would say that for you, this next item might apply: leases of biological assets such as timber. I know that we have a number of clients that do lease stands of timber for their watershed along the river, or perhaps timber along a river to serve as a cooling mechanism for sewer utilities, for example. Leases of an inventory are also excluded. Any type of contract that meets the definition of a service concession arrangement is also excluded. They've also noted, rightly so, that any type of lease where the underlying asset is financed by conduit debt, because conduit debt is on behalf for another entity, the assumption there is that the asset would also be related to that. And for those of you electric utilities on the line, you'll be pleased to know that any type of supply contract, power purchase agreements, those are definitely scoped out of this standard as well. This statement only partially applies to regulated leases. Now, I know we have many of our airport clients on the line, and this is for you, this next couple minutes. Regulated leases have been mostly scoped out of this standard. Now, what is a regulated lease? That is a lease that is subject to the regulations or legal rulings by normally a governmental entity. And the examples that I'm going to provide here right now are through the U.S. Department of Transportation and the FAA. They regulate all aviation leases between airports and the airlines. And this is straight out of the criteria for these aviation leases. And this is, I want to say that the airports did a great job of lobbying GASB to get this in here. But the three criteria, which of course do fully meet the requirement of an aviation lease, the lease rates cannot exceed a reasonable amount, and the external regulator determines whether something is reasonable or not. So it does have to be approved by the regulator. The lease rates need to be similar for lessees that are similar in nature. And the lessor cannot deny a potential lessee the right to enter into a lease if the facilities are available. So again, the most common regulated lease that I believe we'll see is the leases that airports have with the airlines. Now, this is going to be, again, for you airports, this is really only going to apply for aeronautical use. So individuals or businesses providing services involving direct operation of the aircraft or the flight support. You cannot apply this to other things located on the airport grounds, such as flight kitchens, airline reservation centers, any of the terminal concessions, such as the gift shops, the restaurants inside the terminals, that sort of thing. So it is important to, again, for you airports, to make a very clear distinction between your aeronautical leases and non-aeronautical leases, so you're able to really bifurcate what parts of this standard to apply. All right, let's talk about timing. There is time. That's the good news. Unfortunately, because the standard has to be applied retroactively, you do need to start thinking about 2019 as well. But for those of you with calendar year ends, it is effective for the calendar year end 2020, or if you're a June 30 year end, it would be June 30, 2021. But because it does need to be applied retroactively for all periods presented, it is a really good idea to start the process now. Maybe you could do a dry run, get 2019 calculated so that when you are in the year of implementation, you already have that prior year, that restatement amount, you have it ready to go, even if you choose not to early implement. And with that, I'm going to turn it over to Ashley. Ashley is going to cover accounting and disclosure requirements.
All right, thank you so much, Laurie. So first we'll go ahead and start with how the lessor will account for non-regulated leases. So a lessor should recognize a lease receivable and deferred inflow of resources at the very beginning of the lease term. That is unless the lease is scoped out of the standard, as Laurie already described. The lease receivable should be measured at the present value of lease payments expected to be received over the course of the lease term. The deferred inflow of resources should then be measured at the value of the lease receivable plus any payments received at or before the start of the lease term that may relate to future periods. Interest revenue and the inflow of resources should then be recognized in a systematic and rational manner over the course of the lease term. The lessor is required to remeasure that lease receivable if a change occurs and that change results in a material impact to the financial statements. So for example, if there's a significant change in the lease term, if there's a change in interest rate or index, which variable payments are based upon, or if an event occurs in which variable payments become fixed. So if that lease receivable is remeasured for any of those reasons, the receivable should also be adjusted for any change in index or rate used to determine those variable payments, if that change is expected to be a significant impact to the amount of the receivable since the last time you measured it. If there is a change in lease term or interest rate, then you also have to factor in the discount rate and whether it needs to be updated as part of the remeasurement. So as the previous slide mentioned, a lessor needs to measure the lease receivable at the present value of future expected payments. This slide really details what should and shouldn't be included in the lessor's measurement of that lease receivable. So what should be included? Fixed payments, variable payments that depend on an index or rate, variable payments that are fixed in substance, such as a minimum annual guarantee, for example, and then any lease incentives. What shouldn't be included? Well, variable payments that are solely based on the future performance of the lessee or the use of the underlying asset. Those payments should be recognized as inflows of resources or revenue in the period in which those payments actually relate. So if any of the variable payments are fixed in substance, those payments need to be included in the measurement of the lease receivable. So one of the most significant areas of concern that we hear from our clients is how do you calculate the discount rate? When GASB was putting forth this standard, the board did consider whether to provide guidance for selecting that discount rate, but they concluded that the interest rate the lessor charges the lessee, which may be the interest rate that's implicit in the lease, is really preferable because it's essentially the market rate. The board also concluded that if the interest rate that's implicit in the lease is not readily determinable, so you can't figure it out by looking at the agreement, the lessee's estimated incremental borrowing rate could also be used as an alternative. This slide describes how the implicit rate should be calculated if you needed to use the implicit rate, which I won't go into great detail. It's important to keep in mind, though, the two most significant estimates impacting the calculation of the implicit rate is the fair value of the underlying asset and then the determination of the unguaranteed residual value. So again, as I mentioned on the previous slide, one area that requires a significant level of management's estimation is the discount rate. So it's key that management begin developing a methodology for determining that discount rate consistently, which can then be applied as your entity begins to enter into new leases. Another significant estimate that will require management's attention is the determination of that fair value of the underlying asset. And this should be determined using factors that are outlined on this slide, such as the age or remaining useful life of the facilities, the location of the property being leased, the anticipated use or growth trends of that property, and then the local economy. So in terms of disclosures, it seems that your entity's financials will once again grow by a few pages. In addition to the items that are specifically outlined on this slide, the lessor should also provide relevant disclosures for leases of assets that are investments, certain regulated leases, sublease transactions, sale, leaseback transactions, and lease-leaseback transactions. One thing I wanted to mention that isn't included on this slide is if a lessor's main ongoing operations consist of leasing assets to other entities, then that government should disclose a schedule of future payments that are included in the measurement of that lease receivable. So I know we've spent the majority of time on lessors, but now's the time to listen up if you're a lessee, especially as it pertains to what you're going to need to add to your disclosures. So first, you'll need to add a general description of the government's leasing arrangements. So this should include the basis, the terms, the conditions on which variable payments that haven't been included in the measurement of the liability have been determined, as well as the existence, terms, and conditions of residual value guarantees provided by the lessee that have been excluded from the calculation of the liability. You'll also need to disclose the total amount of assets leased and the related accumulated amortization. So this should be separate from the government's other capital assets. In addition, these assets should be separated into major classes. So the easiest way I would think to do this would be to add a separate line item called something like leased assets under each subheading of capital assets. You also need to disclose principal and interest requirements to maturity for each of the 5 years following the reporting period, as well as in 5-year increments after that. And then to provide transparency, commitments under leases before a lease term actually begins will need to be disclosed. And finally, the components of any loss associated with an impairment are required to be disclosed. A lessee, similar to a lessor, should provide relevant disclosures for sublease transactions, sale-leaseback, and lease-leaseback transactions. And one item that actually doesn't need to be disclosed is the collateral pledged as a security for a lease if that collateral is solely the asset underlying the lease. So that's a bit of good news. So for those of you with regulated leases, you aren't exempted from additional disclosures in the financials, as you would imagine. So you'll need to disclose several items, which are outlined on this slide, including a general description of the agreements, the extent that capital assets are subject to preferential or exclusive use, and that will need to be disclosed by major asset and by major counterparty, the total amount of inflows of resources recognized during the period from regulated leases specifically. You're also required to disclose the amount of inflows of resources recognized for variable payments not included in expected future minimum payments, a schedule of expected future minimum payments under the agreements for 5 years and in 5-year increments after that, and then the existence, terms, and conditions of options by the lessee to terminate the lease or abate the lease if the lessor government has issued debt for which the payments being paid are secured solely by those lease payments. So I think I'll hand it back to Emily to administer this next polling question.
Great, thank you. Our second polling question, with regard to the new disclosures required by GASB 87, they will, A, increase the length of my entity's notes to the financial statements by at least a few pages. B, won't significantly increase the length of disclosures, but may change the content. Or C, I do not yet have enough information to be able to predict the impact on my notes. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. I'll give everyone a few more seconds to make a selection here. And we'll close it down in 3, 2, 1. Ashley, back to you.
All right, well, it looks like it's a pretty good mix of, yes, it's going to increase the length of your financial statements, and not yet knowing, because you probably haven't spent enough time really looking into the standard and how it's going to impact your financial statements. And attending this webinar is the good first step. So I am going to now hand it back over to Laurie to talk about preparing for the standard and some implementation considerations.
All right. Thank you, Ashley. All right, let's talk about what we should be thinking about doing next. Well, as I mentioned earlier, sooner the better you get started on it, the happier you'll be in 2020. So I would recommend that the first step be to establish what I would call an inventory of all of your potential contracts that might have leases embedded in them, plus all the obvious leases that you have in the organization. And once you've done that, you can start to go through the contracts and identify key provisions, the lease terms, any extensions, payment provisions, the interest rate, whether it's implicit or if it's easily determined. And we'll talk a little bit about internal controls in just a moment, but establishing communication with the other departments that are involved with leases, whether that is your procurement group, if there are operational departments that enter into leases, anyone that has a say in how those leases are worded, it would be very good to educate them now on what's coming so that you can try to determine if there's a way to get your leases to be more uniform, or at least sets of different types of leases that can have some uniform provisions, just to make it easier later as you gather the information and perform these accounting journal entries. You'll have an ability to go back to just a more uniform, distinct set of contracts and leases. So step one is really this inventory throughout the organization. Now, once you're actually analyzing each lease for the standard implementation, as I mentioned earlier, sometimes identifying the lease term might be the most difficult part. So you really need to look at what is the piece that is non-cancelable, what is the piece that perhaps has options to extend or terminate, and then that judgment call is, are these reasonably certain of occurring? And if so, then you can certainly add on to the lease term or remove from the lease term based on that judgment call. And as I mentioned earlier, you do not have to go back and reassess unless there are unexpected exercises of options or something did not get exercised as planned. It's also important to look at any lease incentives that were provided prior to the inception of the lease, because that is an automatic reduction of the asset for the lessee. If it's something that comes in the door after the lease is already in play, you would look at, again, remeasuring, reducing payments, reducing present value, whatever the impact is at that time. So, again, you can only go with what you know at the inception of the lease and do your best at that point in time. And as long as things are not unexpected or don't change, you can stick with that throughout the lease term. It's also important to identify the contracts. I mentioned earlier there are contracts that have leases embedded in them. So you do need to make a point of making sure that there aren't maybe some unsuspecting contracts out there that actually are leases or have lease components in them, and identify those. And to the extent that you do note a component of a lease in another contract, you do want to allocate the assets and it's a judgment call. You may have to go in and decide, okay, what portion of this is a lease, what asset is related to this lease, what asset is related to this contract that's not a lease, and you'll just have to make your best judgment call in that regard. And I'm going to steal a little bit from Ashley's presentation in a moment. Be sure you document this, because your auditors will want to know what rationale you used when you come in to do this. Now, lease modifications, this is an area where things can get complicated. If there are amendments to the lease contract or other things that are changed later. And so it may make sense to just establish a whole new lease and consider that, trying to piggyback onto a previous contract that's already been accounted for. At some point, you'll have to make the decision, again, internal control that you might want to set up is what triggers remeasurement of a lease liability. What type of amendment do you normally see in your business, and what would be the expectation for when you would establish a new lease going forward, or just assume that, well, this is what we were planning on, this is a routine event that we see. And again, having policies and procedures around the typical lease modifications that you see in your business is important here, and will make your life easier down the road when these things come up, if you already know that you're expecting them. One point I wanted to make sure you understood too is that the GASB does require that a sublease be completely separate from the original lease. You can't net it. So you can't be the lessee and then also be a lessor and a sublease and think that you can just combine all those things and net them out. So it does need to be kept separate. You would need to have the disclosures separate, and you would need to have the accounting separated as well. Something that comes up with our general governmental clients, and I know there's a number of cities and counties on the line today. What about intra-entity leases? The good news here is it's nothing unusual, nothing that you're not used to with respect to transactions that go through to your component units. So if there is a lease with a blended component unit, you would treat that just as you would other transactions with that blended component unit. You would eliminate the calculations of transactions between the two entities before the financial statements are aggregated. So that's, I think, good news that we don't have to do unusual activities with respect to the component units. And as you would suspect, the discretely presented component units, you would just treat that as if it was a lease with an outside party. You would have the receivables and the payables. They'd be separate line items on your financial statements. And of course, you still would have the disclosures in the back, in the footnotes as well. So just to summarize some best practices, I do think, again, the inventory is probably just step one and the best thing you can do to get started. And just consider what is the best way to set that up. Do you have modules that you can use? Do you have, are there spreadsheets? What are you already doing in your organization that's automated that perhaps would lend itself well to this activity? We have had some clients say that they've been able to use their debt management software to actually keep track of a lot of these and generate some of the journal entries. So that's something to think about. I just encourage all of you to think out of the box a little bit about what is the best way to use information technology to track these. There's a lot of software out there that even will go through contracts and identify key provisions. So anything that you have like that can save on the human time in methodically going through every contract is something to look into. I think just trying to set up a clear internal control structure where you look at who's going to prepare these lease determinations, the calculations, the journal entries, and who's going to review them, because you are going to need a very experienced reviewer to be able to say, okay, yes, this was done correctly. So just, again, establishing that clear, strong internal control structure. It's important to also consider what the revenue is going to look like. How will that impact your current financial covenants, your bond covenants? Do you have ratios that you're maintaining that you have to report to others? Do a quick run through. How is that going to change it, if any? And does it potentially put you out of compliance? Because you have time now to get those changed and put into place before the standard takes effect. I think there will be a number of changes to your internal control policies and procedures. It just depends on how deep you intend to go in on this. I would just try to think through the entire process from inception of the lease, who's drafting the leases, all the way to the financial statements. How are you reporting those in the footnotes and in the financial statements themselves? Again, having everything in one central repository, whether you call it an inventory or a repository, just having somewhere where you have everything in one place and an ability to really group them by like kind. Certainly, you probably are very well aware of what types of leases you enter into. Is there a way that you can group them into 5 or 6 categories, whatever makes sense for you, so that you're not keeping track of hundreds of leases, but maybe just 5 or 6 different kinds? And then that's a good way to approach your footnotes as well, because then you might have just 5 or 6 different ways that you're presenting those in the footnotes instead of tearing your hair out with trying to corral 100 different leases into one set of footnotes. So any way that you can try to categorize or group them once you've inventoried them, I think will go a long ways toward helping you make sense of this and get it implemented and then maintained into future years. All right, I'm going to turn it to Emily now for our polling question number 3.
All right, thank you. Our third question, how do you plan to prepare for GASB 87? And your options are A, I'm not going to wait, I'm going to start as soon as this webcast ends. B, look at increasing the communication between departments to ensure all leases that are currently in effect are accounted for properly. C, identify the individuals that will be responsible for implementing GASB 87 and ensure appropriate segregation of duties and establishment of internal controls. Or D, all of the above. I'll give everyone a few seconds here. And for those of you that would like a copy of today's slide deck, you can download that now from the folder that says Slide Deck and Handouts to the right of the slide view. We will also be sending the slides via email after the webcast. And let's go ahead and take a look at the results. Back to you.
Well, we don't see a lot of people that are going to dive in this, today, but that's okay. Look at increasing the communication. That's great. Identify the individuals. Oh, I guess all of the above would capture those that are going to dive in today. So great news. Great news. Everybody is operating with a sense of urgency. All right, with that, Ashley's going to talk a little bit about what to expect from your visit from your auditor after this standard becomes effective.
All right, thank you so much, Laurie. Okay, so GASB has really shown no sign of slowing down on issuing new standards. They really don't sleep. So there have been plenty of implementations in recent years. So the concern over what will change during the audit isn't new for most of us, but I did want to spend a few minutes talking about areas that you can certainly plan for and anticipate in preparing for the standard from an auditor's perspective. So most auditors, Moss Adams included, we will want to have a meeting with management to really discuss what your approach has been for reviewing lease arrangements. So did you set a scope based on a given dollar amount for evaluating leases? We'll probably ask how management plans to record the entries that are necessary for implementation. I would expect this dialogue to continue really for the next few years during your planning meetings as auditors continue to gain an understanding if any liabilities or assets were remeasured during the period. So was there a change in variable payments? Were there updates to discount rates or other estimates such as the useful life of the asset? In addition, there will be more items to evaluate for impairment now. We didn't really touch a lot on that, but with capital leases, these questions have already been really discussed and thought through with management. But with items that were traditionally operating leases under prior guidance, there will need to be a focus on things we haven't had to consider before. So are those operating leases that are being brought onto the balance sheet, are those now impaired? As you can imagine, expect an increase in the number of requests. Auditors will generally need to spend a significant amount of time that first year of implementation just to get their arms around each entity's specific situation. There will probably be a request for more agreements, more memos, or other write-ups that are summarizing management's assessments and their documentation. And there may also be requests for new schedules such as amortization and revenue recognition. As you may know, materiality is generally based on total assets, total revenue, a combination of the two. You should know that materiality scope may increase as a result of this implementation. However, because more management estimate is involved, there may be a decrease in the scope applied over liabilities and over leases. Finally, the chart of accounts. Just be aware, have you created separate assets for lease buildings and equipment? For lessors, is there now an interest income account separate from investment income, deferred inflows, lease revenue? All things that we'll want to know and how those map to your financial statements. So I know Laurie briefly touched on internal controls. Just from an auditor's perspective, when we complete an audit, Moss Adams generally uses the analogy of a bucket. So to gain sufficient assurance, there are 3 ways to really fill that bucket. Control procedures, analytical procedures, and then a test of transactions. Each auditor takes an approach of how much of each they need to fill the bucket. So as you would imagine, for that first piece, internal controls, auditors will really need to understand what processes have changed within the organization to implement the standard. Do new policies and procedures need to be drafted, or do they just need to be amended? Do you have a tickler file or other ways to track when a lease term ends, and you need to reevaluate your schedules for appropriate reporting? Another question that we might ask are, do policies for the allowance for doubtful accounts need to be updated or amended? All things that you need to consider as part of your internal control policies and procedures. Although operationally the lease environment hasn't changed, you may see more focus and questions surrounding how a lease agreement gets entered into, and I know Laurie touched on this a bit. So are there segregation of duties between those that actually approve the leases, those that record the transactions, and those that handle the assets? And are they clearly defined? There will definitely be a focus on communication. So if legal or executive management is the one setting terms or entering into those leases, do they know the importance of communicating with their finance team or actually including them to be part of the process to really assess that financial impact that another long-term liability may have on the financial statements, and if you have debt covenants, those debt covenants? Are there monitoring controls in place to really appropriately review and record these assets? So sometimes due to the complexity, there may be upper finance personnel involved, so you need to ensure that there are other eyes involved in reviewing those schedules and calculations. Of course, whenever debt of any kind is issued, there's usually a focus that the appropriate people are involved to negotiate and act as an agent of the government or entity. You may want to think about if any lease agreements now fall into that category. And then finally, I imagine many organizations will set up reoccurring journal entries to record amortization, so there may be additional IT assessments of systems used to maintain that data and record those transactions. So in terms of testing liabilities for lessees, because lease transactions are typically not predictable in nature, most auditors will sample the additions to the liability balance that took place during the year. So materiality does come into play, but remember our risk evaluation is that entities will have omitted that debt or reduced the liability. So even when balances are small, auditors may make inquiries or selections to get comfortable that those balances should not have been bigger. So still be prepared to provide agreements for leases individually you may think are immaterial. Auditors will also typically sample reductions of existing liabilities. Some may actually request evidence of disbursements paid on lease arrangements, in addition to comparing scheduled amortization payments. In some cases, you may actually see more confirmation requests. Because that initial measurement of the liability is reduced by lease incentives or receivables from the lessor, it will be really important for an auditor to understand these terms. So are they clear and defined in the agreement? Did any negotiations take place outside of the contract that are being considered? Are those documented so there's a proper audit trail for us to look at? It's also important that schedules developed by management include all the important terms, even if they don't impact the liability. For example, if management has already made a determination that a variable payment is performance-based rather than fixed, and that's why it's not included in the liability, that helps get auditors comfortable that management has really gone through and done a thorough assessment of the terms of the lease. Same goes for regulated leases. Even if not determined to be scoped in from a liability perspective, auditors will need to get comfort over those footnote disclosures, so it's important that documentation include all information, even for those agreements. Finally, you may have some discussions to better understand specific terms that you don't consider reasonably certain, but an auditor, we may have trouble getting over that same hurdle to conclude, so just be sure that you're documenting all of your assumptions appropriately so that we have something to look at. Generally, it's challenging to establish analytical expectations over asset balances, so most of the focus will be on additions during the year to right-to-use assets for lessees. You may suggest to the auditors to select those that they are already testing for debt additions, so for expediency, to avoid repetition, redundancy. Typically, asset testing requires getting comfort over a certain coverage, so if that coverage can be reduced or met by testing the same transactions on the liability side, then of course it's efficient all around. Some anticipated errors are included on this slide, and I'll just go through them quickly. Some prepayments made on a lease are not included in the valuation of the asset, so I suspect that those may often get expensed, and if they're not tracked, then we will see assets recorded at the same valuation as the liability, which may or may not be appropriate. Incentives received from a lessor are inappropriately included in the valuation, so rent holidays at the beginning of a lease would be an example. Capitalization of costs that really should be expensed, so insurance, legal, administrative, and then reasonably certain purchase options that are not included in the valuation. So like any other receivable, there needs to be a determination if an allowance is necessary based on history of other lease arrangements, so begin gathering that data now. In terms of maintenance and service agreements, those should be accounted for separately unless the contract does not include prices for separate components. In terms of testing the revenue, that may be transaction or analytically based, and some questions or requests that you may get from your auditors include, for interest income, is that recognition that you're doing systematic? Is the rationale documented? It may not be material, but there may be an assessment of a control weakness if it's not evaluated and documented appropriately. After the initial year of implementation, we'll review for significant fluctuations and then, of course, ask about those and corroborate them if necessary. Documentation whether lease payments secure other debt, and then separate testing may be necessary for gains recognized due to those changes in lease terms. Just a few other audit considerations to be aware of. Laurie did touch on leases with related parties. Just remember to let your auditors know at the beginning of the audit. It's generally part of a request we've already made or included in a questionnaire that you may have filled out. Secondly, ensure disclosure is included in the financial statements. And then accounting may need to be tracked for standalone statements, even if they eliminate between blended component units. For subleases, the guidance is pretty clear. It's important that, again, record keeping as two separate transactions be really easy to follow, and the footnotes will need to be updated from those disclosures originally required under 62 to conform to the information now required under GASB 87. And one thing that isn't mentioned on this slide is if off-market terms are included, are they documented? Are they understandable? Do your accountants understand those terms so they can adjust any entries accordingly? There might be some training that needs to happen at your organization. So finally here, talk a little bit about the presentation and disclosure considerations. So as Laurie mentioned, you will need to restate prior periods and the impact on prior years. So maybe have some discussions now with your auditors on your decision to present 1 versus 2 years and what impact that will have on you and the work that you do. In terms of mapping the financial statements, I mentioned there might be a few new accounts to add, deferred inflows, etc. So that'll take some time to map all those new accounts to the financial statement, so plan accordingly. Of course, your cash flow statements will be impacted with the payments and receipts of cash for the leases. You'll have more to talk about in the MD&A, in the long-term liability and the capital sections. You'll also need to update the statistical sections, relabel them. You're no longer going to have that language capital leases in there. It will just be leases from here on out after implementation. And then your revenue recognition policies will most likely need to address policies related to lease income and when it is recognized. And finally, as Laurie mentioned, you're not going to want to have a page footnote disclosure for every single lease. So to the extent that you can, bucket those similar leases together with similar terms so that they can have their own distinct disclosure. I think I'm going to hand it back to Emily for our final polling question.
All right, our last question. As you look towards implementation, what do you believe will be the most important item for your organization to review? And your options are A, internal control policies and procedures to identify leases and lease modifications. B, the impacts on debt limitations, bond covenants, and grant agreements. C, the mechanics of how leases will be tracked by my organization. Or D, all of the above. I'll give everyone a few more seconds to make a selection, and once you have completed all CPE requirements, you'll be able to download a PDF of your CPE certificate from the CPE Progress widget to the right of the slide view. And let's go ahead and take a look at the results. Ashley, back to you.
Okay, it does look like all of the above is a pretty popular answer, and that makes sense. Internal control policies definitely need to be looked at sooner rather than later, and just the mechanics of how those leases will be tracked by your organization too. The sooner you can start, the better. So I think I'm going to hand it back to Emily to do some Q&A.
All right, thank you. If you have questions for Laurie or Ashley, please enter those in the Q&A window beneath the slide view. And we'll get started with one for Laurie. Can you expand on the concept of materiality? Is there a certain dollar amount threshold we can view as being immaterial for the purpose of scoping out this standard?
Yes, thank you, Emily. I chose this question to answer because there were at least probably 15 or 16 questions that came in pertaining to materiality. So this seemed like the best general one to address the vast majority of the questions that came in regarding this topic. And that's going to be a big management judgment call, and another reason that we recommend that you establish your internal control policies around this standard. I think that there are definitely some leases that you can scope out due to materiality, and then the question just becomes, okay, how do we apply materiality? Big judgment call. I think that you would want to approach that both from a standpoint of individual leases that may be clearly immaterial in their type, in their dollar amounts, but also you could look at it from a group standpoint. One thing that comes to mind is if your entity is the lessee of photocopiers, for example, and they are so small that even if you were to purchase those, they wouldn't even meet your capitalization threshold. And even grouped together, they are not significant in dollar amount to your capital asset account, to your expense account. You know, when you're looking at it from the accounts that is impacting on the financial statements, you can come to that conclusion. I'm not going to give you a magic number, and I'm not going to give you a magic percentage. I think it really does depend on the frequency, the type of asset that is being leased, and the dollar amounts that you're comparing that to. So you should look at the accounts that they pertain to, whether that's the lease receivable, whether that's the revenue or the expense account that it pertains to, or the example that I just gave you with the photocopiers, the capital asset example. So definitely apply materiality. If you're unclear on how to do that, a quick chat with your auditor will probably help a lot. They can give you some ideas. They can give you some ideas on what they care about when they're going to be coming in behind you to audit those assumptions. But I will say that I think you're rarely going to knock up against the auditor materiality for the financial statements. So as long as you're making reasonable judgments, we can understand what that rationale is. We can see the percentages that you're looking at as far as what's causing something to be material or not material. That would be key. So use it. I can't give you huge guidelines on what to do other than these broad strokes, but thinking about it early, getting senior management involved to buy off on those policies and procedures are key.
Thank you,
Okay,
Laurie.
Emily, next question.
All right. When would it be necessary to record an impairment on a lease liability?
Great, thanks, Emily. I'll take that question. So great question. We didn't really touch on a ton of the impairment, but an example might be, say, if a lease building is damaged by a flood, the value of the lessee's right to use that building is actually impacted as well. So Because a lease asset arises from that right to use that underlying asset for a length of time, the utility of the lease asset is associated with the measure of time. So if that lease asset is impaired, as it is in this example, then there often will be a change to this corresponding lease liability. So for example, payments may not be required for the time the underlying asset is unusable. So definitely be aware of the properties that you're leasing, and be sure to talk to your auditors about the condition of those buildings and whether or not an impairment is necessary.
Great, thank you. Let's see, we probably have time for one more question. You touched briefly on short-term leases. Can you clarify when a short-term lease should be recorded?
Sure, I'll take that one too. So Laurie touched on this in the beginning in the definitions piece, but just as a reminder, short-term leases are really defined as a lease that has a maximum possible term of 12 months. So that includes options to extend, really regardless of their probability of being exercised. So it's really getting at the intent at the time the lease is signed. So when finalizing the standard, the board was actually pretty concerned that basing the definition of a short-term lease on the assumption that options to extend would not be exercised would really allow for structuring leases to avoid the accounting requirements. So the way the standard is written is designed to really provide some cost relief for so governments don't have to monitor those leases that are originally less than 12 months, but then extended through an option subsequent to not recognizing that lease liability. So in short, just be sure that if you have a lease that is even just 12 months and you have an option to extend, be sure that you're assessing that to determine whether or not you need to recognize that from a materiality standpoint in your financial statements. Emily, back to you.
All right, thank you. And that looks like all we have time for today for questions. If you still have questions for Laurie or Ashley, you can still submit them in the Q&A window, or you may reach out to them directly. As we did have a lot of questions come in that we didn't have time to answer, we will be happy to follow up with you after the webcast. And I want to thank Laurie and Ashley for a great presentation today. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate now. A copy will be emailed within 2 weeks should you have any difficulty downloading it. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.